Hey everybody, Dominic Nesci here, and here is my update with the RBA at the start, and at the end of this video I'm going to go through what's going on in the property market, so stay tuned. Long story short is the RBA decided to hold the interest rate at 4.1%. They've said the higher interest rate is working to establish a more sustainable balance between supply and demand in the economy, and it's likely to continue to do so. Though they do note that inflation in Australia has passed its peak, it is still too high and is likely to remain to do so for some time yet. So they note they want to get the interest rate or the inflation rate down. They believe that interest rates are high enough to continue pushing that inflation down. But if you go through the report, they also say that some further tightening of monetary policy may be required in order to get that inflation down to their reasonable rate of 2 to 3% in a reasonable time frame. So we're going to have to hold tight to see what they do. For the moment, it's on hold, but it's not going to stay on hold forever. They'll do something with it in the foreseeable future. Now, we're all watching interest rates. All of us property enthusiasts are watching it because we want to know what's going to happen with demand. Lower interest rates are, the cheaper debt is, the more people can afford to buy, and the more likely they are to spend money. At the moment, rates have been going up, so confidence is at an all-time low, and we're watching to see when it changes, because if it does switch from raising and holding to eventually dropping, that's when we think there's going to be an influx of activity. But that isn't the only determining factor of demand. Let's have a look at what's going on across the market. CoreLogic has come out with some new data just the other day. The home value index is up 0.8% in September as demand and supply imbalance continue to push values up higher. So you can see here we've been growing for, I think it's about 9 consecutive months. Quarterly growth has eased, but it is still growing in some markets. Now, the thing that is interesting me, Tim Lawless, the CoreLogic's research director, has said the 3 capital cities recording the highest growth gain each have advertised supply levels at around 40% below their previous 5-year average. Advertised supply levels across Hobart, where values are still trending lower, have been holding above average levels since June last year, where they're almost 40% above the 5-year average. So markets where there's a lot of available supply, the market suffered, and where there's not available supply, the markets continue to grow. Okay, so we've seen dwelling values reach record highs in Perth, Adelaide, Brisbane set to reach a record high in October. And Hobart and Canberra have the furthest to go staging a nominal recovery. Values remain 12.4% and 7% above the cyclical highs from previous year. So the market's still performing quite well. The more expensive Sydney and Melbourne and the broader middle section of the market are now recording the highest growth rate after previously being held by the upper quartile. So what they're talking about here is changes. No, it's not here. It's the quartile. Basically, they're talking about the different quartiles. So within the market, the middle parts of the market's growing the best, whereas before it was the upper quartile. So let's jump into this part of my data. Now, CoreLogic has produced another great report. The unit shortage looms across Australia's housing market. This is really interesting. Now, in August, CoreLogic estimated that units made up about 25% of national housing stock and around 30% of Australia's capital city housing stock. This is up from 19 and 22% respectively. Now, apartments are an important metric to pay attention to because not everybody can afford to go buy these grand homes, and that is where you find the most affordability. It's some of the smaller stuff, and it's the apartment market where you have that affordability. Now, with a median value of 640 odd thousand, this is around 30% cheaper than capital city houses. Now, the interesting thing is what's happening with the apartment stock. The National Housing Finance Investment Corporation has forecast the national housing deficit to be approximately 106,000 less than what we need by 2027, and they later upgraded this figure to 175,000. This is around 59% shortfall expected in the unit market. There's a 59% shortfall than what is needed in the unit market. That's huge. So there are below average unit approvals and completions. You can see here, the ABS approvals data by property type in July had about 4,500 units were approved for construction, which is down 20% month to month, and 40% below the decade average. 40% below the decade average. Excluding a handful of volatile months, the trend in new unit approvals has largely held below the decade average since mid-2018. You can see that here. National monthly housing approvals by property type. About 2018, this is a unit, the lower line. We've been recording below average approvals for the apartment market here since 2018. There's a couple of spikes, but it's been just low levels of approvals. Now, housing, you can see this massive spike in approvals happened during post-COVID, when they did the home builder bonus and grant. But it has been coming down since then and is quite low and has remained low for the past couple of years. So, in the past 10 years, units have accounted for about 41% of total new housing completions nationally. However, in March quarter 2023, units made up just 37% of completions, holding around 27% below the decade average. So there is a huge number of apartments that are not being approved, that are approvals that are low, and there's a huge number of apartments which are not being completed. So there is a massive supply deficit coming to the market. The other interesting thing here is to pay attention to supply and demand. Now, supply is really low, which is tight. But what's happening with demand? There's an increase in demand from the imbalance between overseas arrivals, people coming into the country, and then departures, people that are leaving. Now, what you can see here, in the year to March 2023, net overseas migration reached a record high of 450,000 people being added to Australia's population. 450,000 people coming to Australia. At the average household size, this equates to an additional 182,000 households need to be completed to house all these people. There's a huge housing shortfall happening here. Now you can see here, where are all these people going? Firstly, it's New South Wales. Secondly, it is Victoria. You have a big gap, and then behind that you have Queensland and then Western Australia. So I want to just point into some more data here. This is more on the population data front. You can see here. Okay, so population change across the states and territories. It's all well and good. Yes, New South Wales is the big winner. But to invest in New South Wales is quite difficult just because of affordability. If you haven't got a massive budget, the other places you should be mindful are Victoria and then Queensland and Perth. And let me point to you why. Now, obviously, New South Wales has been a huge winner. We've seen change over the previous year, 56,000 people. Victoria has been a big winner, 161,000 people. And then Queensland, 124,000 people. Massive numbers. Now, the other interesting fact is to watch net interstate migration. This is people coming into Australia, and then what are the people that are in Australia, where do they go, and then where do they move to? You can see here that actually 30,000 people leave New South Wales, 5,500 people leave Victoria, and then the big winners are Queensland receiving 31,000 people, and then Perth receiving 11,000 people. So, it's all well and good to be able to afford New South Wales if you can. Buy in Sydney, that's the premier city. People hate me saying that, but it is. If you can't afford Sydney and New South Wales, then the big winners are Victoria, Queensland, and Perth. If you're just looking purely at what's happening from a population front. Now, another interesting piece of data to just have a quick look at is just top-level data. KPMG, house prices set to surge in 2025. They see house prices will rise nationally 4.9% over the next 9 months. And then there'll be a surge of 9.4% in the year to June 2025. Let's just do some quick math. Say you buy a $650,000 property. And then that property grows, let's just round it up by 10%, times 0.1. That's $65,000 of additional growth. That's not bad. If you're picking your investments wisely, you're able to get into the market, that's not bad money to be earning. Now, obviously, some people can afford to spend more and be a lot more selective, so that growth rate is going to impact different people differently. So the big thing to think about, my key takeaways out of all of this is, one, RBA's cash rate is currently on hold. They may increase it, but in time, once that inflation rate comes down, they may start to cut it again, so pay attention to that. Two, we've got a huge amount of people coming into the country. The big winners for population growth, New South Wales first, Melbourne just behind New South Wales, and then you've got to have a look at what's happening with the interstate migration. Queensland is getting a huge amount of people from interstate migration and from net overseas migration as well, and Perth is a big winner as well. The last thing to be mindful of is the fact that there's just a huge undersupply of completions, properties completing, and a huge amount of approvals that aren't being properties that aren't being approved. So massive amount of supply going down, huge amount of people coming in, cash rates remaining as is. If that cash rate starts to cut, confidence will come back into the market, and that's why people are starting to say there will be a surge in property prices. Anyways, I tried to keep it under 10 minutes. I failed, but I hope you've got some value. Happy house hunting, happy investing. If you have any questions, feel free to reach out to myself or the team. I'll see you later.